Welcome back, everybody. Ready for another deep dive?
Always excited to explore something new. What are we tackling today?
Well, today it's something I know a lot of folks find kind of fascinating, maybe even a little intimidating, right? Investing.
Ah, yes. Investing. Big topic.
It really is. We're going to be focusing on this whole idea of market predictions,
Right.
like trying to figure out what stocks are going to do what. Everybody wants that crystal ball.
Absolutely. Who wouldn't want to know what the future holds, especially with their money on the line?
I know. And I was reading about this, how like even with all this fancy AI nowadays,
Yeah.
all these algorithms that can crunch crazy amounts of data.
Mm-hmm.
It turns out they still can't accurately predict how the market's going to move.
Yeah, that's something that surprises a lot of people. It really highlights the complexity of the financial markets.
It makes you think like with enough computer power you could figure it out, but
You'd think so, right?
apparently not.
It's not quite that simple. It turns out the markets are influenced by this massive mix of factors. Some we can measure, like economic indicators.
Right.
And some that are a little more elusive.
Okay, so that's what I'm curious about. Like, I get the whole inflation rates and unemployment numbers and stuff. Like, that's pretty straightforward.
Sure.
But what are these less tangible factors that you're talking about?
Well, take, for example, remember that volcano that erupted in Iceland last spring?
Oh, yeah.
That obviously caused a lot of disruption to air travel, especially across Europe.
Oh, yeah.
You know?
Huge mess.
And, well, that had some pretty big ripple effects in the market.
Oh, interesting.
And that's a real-world event. Totally impossible to predict, right?
Yeah.
But it shows how things outside of just pure economics can really impact things.
Oh, for sure.
And then you have things like investor sentiment, which is kind of a tricky one to pin down. It's basically the mood of the market. Are investors feeling optimistic? Are they feeling pessimistic? And that collective feeling can have a huge impact on how prices move.
So you're saying it's almost like the market has its own psychology. Like it's driven by crowd behavior in a way.
Precisely.
That's actually kind of unsettling when you think about it, right?
Yeah.
Because you can't necessarily predict what everyone else is going to do.
That's exactly why relying solely on predictions when it comes to investing can be very, very risky. You're essentially trying to outsmart the entire market, which, let's face it, is a pretty tall order.
It really is. So if we can't predict the future, I mean, what are we supposed to do? Just throw darts at a board and pick stocks randomly?
No, not at all. Haha. That's why you hear financial experts talking about these long-term investment strategies.
Okay.
The idea is to focus on that steady, sustainable growth over time. Instead of trying to time the market perfectly, which almost nobody can do consistently, you're playing the long game.
Right. I have heard that phrase before, like time in the market is more important than timing the market.
Exactly. Think about it like planting a tree. You don't plant a seed and then worry about every little gust of wind that might rustle the leaves.
Yeah, that's a great analogy.
You're focused on that long-term growth, nurturing it, letting it develop over time.
So, okay, you're playing the long game, you're planting that tree, but how do we actually put these long-term strategies into action? What are the nuts and bolts?
Well, one of the foundational elements is diversification.
Okay.
Don't put all your eggs in one basket, right?
Right.
I know it's an old saying, but it holds up for a reason. You want to spread out your investments instead of betting everything on a single company or one specific industry.
And how do people do that?
A popular approach, one that I often recommend to people who are new to investing, is called a 60-40 portfolio.
Okay.
60% of your investment goes into stocks. That's the growth potential, right?
Yeah.
And then the remaining 40% goes into bonds, which are generally considered to be a bit safer and less volatile.
So it's all about balancing that risk of reward.
Absolutely.
But wouldn't that also potentially limit your gains, though? Like, what if that one company that you didn't invest in suddenly, takes off?
That's always a possibility, and it's a trade-off you have to consider. Yeah. But remember, with a long-term strategy, you're not chasing those short-term gains. You're not looking for the next big thing that's going to explode overnight.
Okay.
You're in it for the long haul. You're trying to build that solid foundation. And beyond diversification, risk management is another crucial element.
Okay, so that sounds like it's all about, not getting in over your head, knowing your limits.
It's definitely part of it, but it's also about anticipating potential challenges.
Okay.
Imagine you're planning a road trip, right? You wouldn't just jump in the car and start driving without any thought, would you?
No way.
You'd check the weather, you'd plan your route, you might even pack a spare tire just in case.
Always a good idea.
With investing, risk management is kind of similar. It's about understanding your own risk tolerance. How much volatility can you handle? Are you comfortable with big swings up and down, or do you prefer things to be a bit more stable? And there are tools that can help. Like you can set stop loss orders. This basically tells your broker to automatically sell a stock if it drops below a certain price, so it helps you limit those potential losses.
Oh, interesting.
It can be a really good safeguard.
It's smart.
And then it's also worth considering having an emergency fund,
Okay.
especially for those unexpected market dips. Just like you might have an emergency fund for unexpected car repairs or medical bills. Having some cash set aside can give you peace of mind and prevent you from having to sell investments at a loss if you suddenly need money.
Yeah, that makes a lot of sense.
Yeah.
So it's about being prepared, having that plan.
Exactly. And it's not just financial preparedness, it's mental preparedness as well.
Oh, right.
You have to go into this knowing that the market can be unpredictable. There will be ups and downs, but you've got those safeguards in place, and that can make a big difference in your overall experience.
Right. So we've covered diversification. We've talked about risk management. Is there anything else? Like, are there other key things that people should be thinking about as they kind of, get started with this long-term approach?
The final, and I would argue maybe the most crucial element, is what's called fundamental analysis.
Okay.
This is where you go beyond the hype, beyond those flashy headlines, and you really dig deep into the actual substance of what you're investing in.
So it sounds like doing your homework, basically, right?
Exactly. And look, you don't have to become a financial analyst overnight, right?
Right.
But you do want to have a grasp of the basics when it comes to a company's financial health. It's like, if you think about it like dating, you wouldn't marry someone just based on their profile picture, would you?
That's a good point.
You'd want to know about their values, their goals, their past experiences,
Definitely.
With a company, it's similar. You look at their earnings, their debt, their management team. See if there's any, red flags or things that concern you. Try to get a sense of whether what they're saying about themselves actually lines up with their financial track record.
So you're basically trying to separate the sizzle from the steak. Like, is there real substance behind all the hype?
Exactly. And honestly, this is where consulting with qualified professionals can be incredibly valuable.
Okay.
Financial advisors, economists, analysts, these people have the training and the experience to guide you. They can help tailor strategies that align with your individual goals and help you navigate the market's complexities. They've seen it all, so they know what to watch out for.
So we're diversifying, we're managing risk, we're doing our research. Is there anything else that people should be doing to stay informed? Just to make those smart decisions over time.
Yeah, staying informed is huge.
Okay.
Keep an eye on current events, economic news. Look for developments in the industries that you're interested in. But be discerning about your sources. You want to make sure you're getting your information from reliable places, Look for respected financial publications, nonpartisan economic think tanks. Those will help you avoid getting caught up in biased or sensationalized information, which is everywhere.
Good advice. Well, I think we covered a lot of ground today.
Yeah.
So to sum it all up, it seems like the main takeaway is that even though we can't perfectly predict every single move the market's going to make, we can definitely make informed choices that can help us navigate it successfully.
Well said. And I think it's also important to remember that investing isn't just about potential profits.
Okay.
It's about participating in the economy, potentially growing your resources over time, and really having a stake in the future that you want to see.
That's a great point to end on. And for all of you out there who are interested in this whole world of investing, just remember, keep exploring, keep learning. Knowledge really is power. And on that note, happy diving, everybody.